Welcome to Home Learning. In accounts today, we're going to be learning about the reconciliation statement. It is our bank reconciliation statement. In today's lesson, we're going to be looking into our two accounts. The first account that we're going to be considering, it is our cash book. Cash book, we know it is one of the books of original entry. The cash book, we want it to correspond with our bank statement. We want it to correspond with our bank statement. When we look into the cash book, we are going to be focusing more on our bank column. We're going to focus on our bank column. Why the bank column? Because the bank column is the one that uses our bank account. Each business is entitled to have a bank account. So whatever transaction that is going to go via the bank, we record it under the bank column in the cash book. Remember, the cash book is one of the subsidiary books. What are we then talking about when we're talking about a bank statement? A bank statement, I am going to say it is a summary of all transactions in the personal account or in the business account that has occurred during that given period of time. Normally, our banks are efficient enough to give us bank statements on monthly basis. So businesses are encouraged to go to their banks on monthly basis so that they are able to reconcile their cash books. What happens in banks? We know that, or we have learned when we're preparing the cash book, that there are other methods of payment that you can use. And these methods of payment could include the following. The first one, we are talking about methods of payments through the bank. Methods of payment through the bank. They are not going to be limited to this that I'm going to say. It is a check. We all know a check because we have used the check when we're recording in our cash book. Then we've got credit transfer. Credit transfer. When the transfer of money is automatically done through the bank, you instruct the bank to transfer certain amount of money to the named payee. That is a credit transfer. Then we've got a stop order. The account holder will instruct its bank to make regular payments on monthly installments. In that way, in our cash book, definitely it is not going to be reflected until I get what? Until I get my bank statement. Because how will I say this transaction has occurred if I do not have a proof? When you record in the books of original entry, remember there must be a written down document. So in this case, our written down document will be in the form of the bank statement. It is proof enough that the bank has already made a payment, or we have received payment from our debtors through the bank. We've got a debit order. Debit order in a credit transfer could work. These days we've got internet banking. Internet banking. This person do not come to the shop premises, but will do the transfers, will just do the transfers in his or her comfort zone, but will not come to the business. So our cash book will not reflect that amount of money. In that way, we need therefore to do what? A reconciliation statement. We need to reconcile. When we are reconciling, when we say we are reconciling, what are we doing? We are bringing together two differences so that they give us one. They have to agree. When we reconcile, these statements must agree. We have seen that through the bank, there are several ways in which you can make payment which does not touch the cash book, but it must be recorded in the cash book. So that is why, therefore, we had to learn the reconciliation statement. In that way, when we look into our check, the first example that we gave, people come to the business and give us a check. We have not presented the checks. It is given 6 months. Thereafter, it is said to have lapsed. So within that 6 months, before you can deposit it, or you can go to the bank to withdraw money using the check, then in that way, I have recorded already in my business that I have issued out a check, but you have not, because of this allowance. You have not gone to the bank to get the money. In that way, it simply means you have the check with you and the bank balance is still the same, whereas in my cash book, the balance is now less with the amount of check that I have given you or I have issued. So that is why checks, they need to be either deposited if the business has received the check as payment from debtors, or they need to be presented. They need to be presented in the bank if we have paid who? The creditors. I want us to be very, very careful when we do this. It's very simple, but it needs our attention. Deposited when we have received from our debtors. But as long as we have not deposited it into the bank, our bank balance is not going to be the same as our cash book. Remember, we have included it in our cash book. We have received it. Today it is the day that we receive it. Therefore, we are going to record it as per the received date in our cash book. But definitely in the bank, they're not going to record it. So that is where the differences are going to be. I hope we understand how the balances in our cash book and bank statement, they end up not being the same. We're going to be looking into an example of such. We're going to look into an example of such. We have our cash book. I want us to pay attention to our cash book that is in front of us. We will pay attention to our cash book. Our cash book has a balance brought down, that is an opening balance, and it has a closing balance of 550. Within those balances, we've got, remember the cash book, it is the bank column. We are focusing on the bank column. We've got something called the cash transfer. Transferred money from the cash to the bank account. So that one is not going to hinder us anyway, because definitely we had deposited the money immediately. But when you look into these debtors and creditors that are in the cash book, we therefore have to check in our bank statement if they do appear. We issued checks or we have received checks. Let me give an example. On the 5th of March, we might have issued a check to M. Sugati. Let us check our bank statement whether it shows that transaction. On the 5th of March, we issued a check to M. Sugati. Does that appear in our bank statement? Let us look at our bank statement. This is our bank statement. Nothing on the 5th of March. This shows us that M. Sugati has not presented the check. M. Sugati has not presented the check for what? For payment in the bank. Definitely. Now, the balance will definitely be affected. Can you see? Very simple. So you need to note. Where are you going to find this? You're going to look at it on the debit side of the bank statement. M. Sugati is not found on the debit side. That means the bank has not yet received the claim of that check. Therefore, our bank balance is going to be different from our cash balance. I want us to note together the discrepancies that we are going to see in terms of transactions found in the cash book but not found in the bank statement. Let us go through the cash book. I want us to go through the cash book once again and pay attention to that. Definitely, we have not recorded this in our bank statement. When we move on the 8th, yes, I did notice on the 8th, it was there in our bank statement. But when we look into S-Dube 1.8, we cannot find it in our bank statement. It is not there. That is the first thing you need to do. First, identify the transactions. First, identify the transaction. We have the data that has paid us on March 10. It is there, 3,300. And Langa, that's fine. When we look into our balance, it is not the same. We have 550 and they have 2910. That is what we have to correct. I want us to move to our bank statement. What is it that we are going to find in the bank statement? Maybe there is a payment that was through stop order. Maybe there is a payment that was through credit transfer, debit transfer, or a payment that was made through internet banking. So we want to check on that. Which payments do we find in the bank statement that we do not find in our cash book? We have, first thing is the bank charges. The bank charges are not shown in our cash book. Definitely they are not going to be shown because it is the bank that decides how much it's going to charge you that month, depending on how often you were using your account. There is a deposit interest. That simply means whatever amount of money you deposited in the bank is giving you, you are earning an interest because of those deposits. We also do not have this transaction in our bank in our cash book, but we have it in our bank statement. There is also a check of 500 that was deposited by Mavuso, which we have not seen in our cash book. We have not seen in our cash book. It was deposited directly into our bank account. Therefore, we had no way to record this in our books of accounts. that is the cash book. These are the 3 items that we need to correct. These are the 3 items that we need to correct, and they must appear in our cash book. When we look into our balances, we've got the opening balance and the closing balance. When you look into our opening balance, definitely it is not the same. Even the closing balance is not the same. What are we going to do now? We're going to be focusing on the closing balance. The opening, so that the next month or the next period, the opening balances are going to be the same. The opening balance of this period is going to be automatically corrected using the transactions that we have identified. Using the transactions that we have identified. The first thing that I want us to do, I want us to open our cash book. We are not going to open a cash book again, but we're going to open something called a supplementary cash book. We are going to open a supplementary cash book. Why are we opening a supplementary cash book? We are trying to correct the balance that we already see in our cash book. We are supplementing it with these transactions that we have identified. We are supplementing it with these transactions that we have identified as they were recorded in one of the books or in one of the recording side, but not appearing in the other. In this case, they were recorded in the bank statement. The bank has information to it, but we do not have information to it. So what are we doing now? Now we are going to include it in our information, and our information is going to be where? In our cash book. So our cash book is going to be a supplementary cash book. In our supplementary cash book, I'm not going to draw all the columns. I hope you will understand. I want us to focus on the bank column. We are focusing on the bank column. This was 2015. The balance that we are correcting as per March 31, we had a balance of 550. This is the balance we are correcting. This is the actual balance we are correcting. Therefore, we are going to be looking into the credit side of the bank statement. On the credit side of the bank statement, we had a deposit that was on the 1st of March. There was a deposit from Mavuso. Mavuso deposited a certain amount of money of 500, which in our cash book does not appear. Then we also have on the 20th, the bank gave us a deposit interest. Deposit interest. A deposit interest of how much? 180. Then we are going to look into the debit side of the bank statement and find out the transactions that appear in the bank statement which do not appear on our credit side of the cash book. That is on March 28, we had bank charges which did not appear. The bank charges were 220. The bank charges were 220. Now we are balancing the cash book for us to find the new balance of the cash book. Remember, the balance that we are correcting, it is 550, which is this balance brought down. That is the balance we are correcting because it is not the same as the one in our bank statement. Brought down 10, 10. Remember, this is 31st March and this is going to be the 1st of April. 1st of April, we need to have a balance of 10, 10. This is the corrected balance. This is the corrected balance of our cash book. Now, we are looking into our bank statement. The bank statement has a balance of what? 2910. It has a balance of 2,910, which is not the same as our cash book. So what are we going to do? We are going to be doing a bank reconciliation for the given period. A bank reconciliation statement for the given period. So what are we going to be doing? We'll start with the balance as per bank statement. The balance as per bank statement, the statement balance that we are given, which is the closing balance. Balance as per bank statement. Our balance as per bank statement is 2,910. This is the balance we are correcting. What are we going to add? We need to add what was not credited. Add uncredited checks. What do we mean by uncredited checks? These are checks that we have received from our debtors, but they do not appear in our bank statement. That simply means we have not deposited these checks in our bank account as a business until month end. We have not deposited, so seemingly we have not received the money. We have not received the money on behalf of the business. So the bank will not have that amount of money. So which checks are they? Are those? The check, it was a transfer that we decided to make on the 30th of March. This transfer, it was made on the 30th of March when our bank statement had already been printed out to us. Remember, our bank statement is as at 28th of March. So our transfer was after the 28th, therefore it was not appearing. So our transfer, cash transfer, which we need to add to the balance, 2,400. When we add this, we come up with 5,310. We go to our debit side. We had made checks to our various creditors. Have they all presented? Let's go back to our credit side. M. Sugati had not presented the check so that he gets money from our account. So we're going to subtract it less unpresented checks. Less unpresented checks. These are the checks that we have issued out, but the owners of the checks have been given a leeway of 6 months or so, and they have not yet presented them in the bank to get money from our account. M. Sugati is the first creditor. Then the last one is going to be S. Dube, who has also not presented the check that we issued of 1,800. then the total for the unpresented check must be subtracted from the total of our bank statement amount. It has to be the same as the balance as per cash book. I want us to analyze per column. When you look into our bank statement, we have got the debit column, we've got the credit column, and we've got the balance column. When we're talking about the debit column in our bank statement, we're talking about those transactions that are an expense for the business. That is why when you look at the balance, it is 5,450. But after the debit transaction, the balance is reduced. That is, it is less by the debit transaction. But when we look into our credit column in the bank statement, are those transactions that gives us money as a business. They increase our balances. When we look into the next transaction, which is a deposit and interest, we received interest from our bank because of the deposits we have made. In that way, our balance has increased. You need to pay attention to this. For your exam purposes, it is very, very important so that you know when you are focusing on the debit side of the bank statement, you need to focus on the credit side of the cash book. Focus on the credit side of the cash book. But when you look into the credit side of the bank statement, automatically it must refer you to the debit side of the cash book. That's how simple it is. Then the balance column is so simple that for every transaction you need to total up. Either you are adding or you are subtracting. This, it is what we have learned about when we're doing what we call the running balance. The running balance. When we were preparing the ledger accounts using the running balance, this is what it means. The running balance simply means for every transaction there must be a balance. For every transaction there must be a balance. I hope you get that correct now. I want us to do the second section of the reconciliation statement. The second section of the reconciliation statement is talking about us preparing in a different way a reconciliation statement. A reconciliation statement, as we have done now, we have prepared a reconciliation statement starting with the balance as per bank statement. What if we start with the balance as per cash book? What are we going to do? The balance as per cash book that we're going, now we started with the balance as per bank statement. Then we need to variate. What if you have not been given? Then the safer way, it is to use the balance that is in the question paper. If you need to calculate the balance in the bank statement, please do not, because you are going, unless the question asks you to calculate, then use balance as per bank statement. But use the balance as per cash book. It is going to be safer and faster for you to prepare. Bank reconciliation statement. I want us to start with the balance as per cash book. Balance as per cash book. Balance as per cash book. When you start with the balance as per cash book, definitely you cannot add uncredited checks. You have made those those you have received that amount of money in your cash book. But what is it that you need to add? You need to add what has not been added upon. Balances per cash book. Which balance? We have learnt that in our accounts, we've got two balances, opening balance and the closing balance. And we have prepared the supplementary cash book. Now we've got three balances. Can you think? Think seriously. Which one are you going to? This is normally a challenge to our students when they are preparing the books of accounts. They start with the balance as per bank statement, which is given to you. They add uncredited checks, which is correct. But once they start with the balance as per cash book, they need to add unpresented checks. Why unpresented checks must be added? We have subtracted them from our bank account, yet the creditors have not claimed money in our account. But we have already subtracted it. So now what are we doing? We are bringing it back into the account. Until who? Until the creditors are able to go and withdraw money from our account using those checks. That is why we need to add the unpresented checks. And we need to subtract the uncredited. As a business, we have included this amount of money in our books of accounts, that is in our cash book in this case. But the bank has not received that amount of money. So we need to do what? We need to reduce it. We need to reduce it. Balance as per cash book, we are given it is at 550. Then unpresented checks, the checks that we had already made a payment to. Those checks, they include Sugati and who? Sugati with 3,000 and Dube with how much? 1,800. Let us add this into the balance. It's going to be 0, 5, 13, 53.50. The uncredited check, remember, it is the cash transfer which was done after the bank statement was given to us. Cash transfer of 2,400. This will come as a balance as per bank statement. 2,950. This will come as our balance as per bank statement. This is what we expect to get from the balance as per bank statement. I want you to pay attention on the opening balance that you are using. I want you to pay attention on the opening balance that you are using. Now we have started with the balance as per cash book. I want you to pay attention to this. Once you start with the balance as per cash book, you add unpresented checks. Unpresented checks. What do we mean by unpresented checks? Are those checks that the business has written out to its creditors, but the creditors have not yet gone to the bank to claim money from the business bank account. The checks are said to be unpresented by the creditors in the bank, the business bank, in order to claim money from our account. We subtract uncredited checks. This is very important. Uncredited checks are subtracted once you start with balances per cash book. Simple because you need to reduce the amount of money you have written in your cash book, whereas you have not yet deposited it into your bank account. We are reconciling this term. We are trying to bring things together. What you have not done and the other one has done, let the other one do it again. I have not deposited the amount of money as a business into my bank account. So the bank account will not have that amount of money. So let me also reduce it until I deposit it into the bank. Then our balances are going to be what? They are going to be the same. I hope that is clear. When we use balance as per cash book, we add unpresented checks and we subtract uncredited checks. Let's look into the previous one. The previous one, we started with the balance as per bank statement. The previous one, we started with the balance as per bank statement. What are we saying in the balance as per bank statement? The bank has so much in our account. According to this statement, the bank has got 2,910 in our account. Everyone can see that. Why? Because there are transactions that appear in the cash book which the bank has not yet recorded. There is no document that will instruct the bank to either deduct or increase our account. Therefore, what has not been done in the bank, it is a deposit. When we made the cash transfer on the 30th, we had not deposited. So the bank is doing what? It is adding uncredited checks, the vice versa of balance as per bank or as per cash book. Add uncredited checks. We are going to deposit what has been done in the cash book but has not been done in the bank statement must be done when we are reconciling. That is why we are adding uncredited checks. The uncredited check was a cash transfer of 2,400. Then we need to say less what? Unpresented checks. Because the bank balance has not reduced the amount of cash that the business has paid out in forms of what? Of checks. In forms of checks. We have made a check to M. Sugati of 3,000. M. Sugati has not gone to the bank to present this check. We have also made a payment to S. Dube of 1,800, and S. Dube has not done what? Presented the check for payment, has not withdrawn money from our account. That is why our bank statement balance is going to be different from our cash book balance. I hope you now understand why those two accounts need to be reconciled. Why those two accounts need to be reconciled. We have some few questions that goes along with the reconciliation statement. Mainly the practical or the theory part of it is based on the terminology. You need to understand the terminology as I have explained in the beginning. We have been doing the practical part of it, but you need to be also focusing on the theory part of it. It carries some marks, more especially in paper 1. You're going to find more of this theory part in paper 1. What is it that we are talking about when we're talking about the theory part of a reconciliation topic? This topic, for your own information, goes further to the control account. You will find yourself reconciling even control accounts. So that is why it is vitally important for you to understand a reconciliation statement. It has got the same principle when you reconcile control accounts. When we are talking about the reconciliation statement, there are some key terms that you need to understand. The first term, it is uncredited checks. Uncredited checks. You should be able to explain what you mean by uncredited checks. If you cannot explain uncredited checks as money not yet deposited by the business into the bank account, then you are going to lose something like 2 marks, which is a lot of marks. You need to grab as much marks as possible when you are doing the reconciliation statement. It is very easy. That is where you need to maximize your marks. Then the second one is going to be unpresented checks. This is another terminology that goes along with reconciliation topic. Checks that have not yet been presented by creditors to claim money or to withdraw money from our bank account as a business. They have not yet presented. Remember I said there is something called a stale check. A stale check, it is a check that is more than 6 months. You have not presented this check for payment and the check was written 6 months ago. Then that check is going to be said, it is now what? Stale. You need to go back to the person that has given you the check, that is the drawer of the check. The drawer of the check must rewrite another check to you so that you are able to claim or to withdraw money from the business account. The next one is quite a variety. It has to do with the methods. The methods of payments. The methods of payments through the bank. The methods of payment through the bank. We are being given that there are several methods of payments through the bank. When you are writing your final exams, you are expected to explain some of these methods. For example, a stop order. It could be a stop order. It can be a direct debit. What do you mean by direct debit? What do you mean by standing order? In these days of technology, what do we mean by internet banking? What do you mean by internet banking? Please make sure you try to get this as much as possible. Most of our paper 1 is going to ask such questions. So it is vital for you to also focus on the theory part. These are some of the methods. I know I have mentioned others, before. But these are also vitally important for you to be able to define those terms. It is going to help us a lot in maximizing our marks. I expect the students this year to, most of them, credit our accounts, because accounts really are the practical things that we do on our daily lives and practical things that we see on our daily lives. Internet banking, you know internet, and we are keen to use internet. Therefore, what do we mean by internet banking? Just to define that, we'll give you 2 marks, which you have just grabbed free of charge. I want us to move on to talk about 2 things before we summarize. The 2 things that I want us to talk about, it is the types of balances that you may find in a bank statement. The types of balances in a bank statement. The first one, we say it is a favorable balance. Favorable balance. The second one is known as the unfavorable balance. When we are talking about the favorable balance, we are simply saying our bank account still has got enough money for us to further do the business operations. If it is favorable, at the end of the balance, you will normally see credit. That simple means we still have enough money to take us further and do the business operations. Favorable balance. We still have enough money in our bank account. As per our exercise showed that we still had enough money in our bank account for the business to operate. Remember, when we learned about the business concept, we talked about the continuity of a business. A business must not be a business today and tomorrow there is no business. So the continuity part of it is also going to be shown in our bank account, or must always be shown and guaranteed by our bank account. We should have a favorable bank balance. Favorable bank balance. What then do we mean by the unfavorable balance? The unfavorable balance, it is when we have a negative balance in the bank. Negative balance. The business does not have any money in its bank account, but has even went further to use the bank money. In that way, when it is negative, it is now an overdraft. This is another terminology that they can ask you in paper 1. Explain what we mean by overdraft. Overdraft in our bank statement is always given a notation of OD. Once you see OD, definitely it is unfavorable, and it simply means overdraft. You have withdrawn more money from your account than you have. Therefore, the business has got what? An unfavorable bank balance. These 2 terminologies are normally a problem to our learners in terms of explanation and in terms of identifying them when they see them in the bank statement or in our cash book. How do you see them in the cash book? That it is favorable. When you are in the cash book, favorable balance will always have what? A debit balance. In our cash book, a favorable balance will always be shown on the debit side. But in the bank statement, a favorable balance will always be shown in the credit side. But an unfavorable balance in our cash book will be shown in our credit side. If the balance is unfavorable, it will be on the credit side. That simply means the expense side is more than the income side. What we have received as a business, we have spent more. And in that way, it is unfavorable. It is now an overdraft. So you need to know these things. And you should be able to explain them. When we look into our lesson today, we were trying to reconcile our bank statement and our cash book. We have identified the differences when we look into the bank statement and the cash book. The first thing that we did was to identify the differences, which is the first step that you also have to do when you are given such a question in the examination. Identify the differences. First, it was the balance. Once you look into the balance of the cash book, different from the balance as per bank statement, then you know there are transactions that are different from each other. The question can come up and say, what causes the differences? I have mentioned to you that the differences within these two balances are as a result of the methods of payment that we have been given by the bank to use as a business. The methods of payment that we have been given by the business to use. These are some of the methods of payments that we were talking about that may cause the difference in the balances. It was the check, which the business can issue out, and the person or the creditor that has received the check will not go to the bank immediately. So in that way, the bank and the business will have two different balances. We've got something called the credit transfer, which you need to also define. You've got debit order, we've got the internet banking, we've got stop order. Several of these methods that you can do or you can use in a bank. In that way, our bank statement will also show some of the activities that were going on in our account, in our absentia. The people were depositing money into our accounts, not us knowing. When we look at March 1, for example, the check deposit of Mavuso. So those are the things that we are trying to reconcile in this topic. We also go and check the bank statement, try to reconcile the bank statement, and in that way, you will have the same balances. Thus, when you prepare your final books of accounts, it will be the same balance. We will expect to get 1,010 in the bank account, so it is what is reflected in our cash book. That is the end of our lesson today, and I hope you're still going to enjoy watching home learning. Goodbye.